Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. In today's episode, we will hear about the role of transfer pricing in the context of global trade. My name is Dana Hart, and joining me today, I have Isabel Verlinden, PwC's Global Transfer Pricing Leader based in Brussels. Also joining me are Jeff Yuan, PwC Partner and Leader for Transfer Pricing in China, William Marshall, a Partner and Trade Attorney based in Hong Kong, and Pascal Janssens, PwC Belgium's Indirect Tax Leader. Isabel, I'd like to go ahead and turn it over to you to get us started.
Thanks, Dana. Hi, everybody. It's a pleasure to be here on this podcast with a specific group of people here, because we're going to talk today about something that's a bit peculiar as transfer pricing practitioners, because we're going to look at the interface between tax and trade policy and what sort of issues this might pose for countries, for multinationals, and for any other stakeholder. And this is where our kind of provocative title comes from. Are taxes speed bumps or catalysts on the international global trade highway? And we see a number of initiatives worldwide, like U.S. tax reform. We see some, let's call it pretty aggressive state aid attacks from the European Commission. We see a European Commission proposal on taxation of digital transactions. We see a number of initiatives that might come across as pretty protectionist. And as tax practitioners, we fear that there are a few of these developments that may end up in a situation where we face multi-layered taxes. And the question is whether this can't harm investments and, at the end of the day, also economic growth. If we look, for instance, at the European digital service tax, which is still not off the table, but which will be, again, discussed within the EU on digital transactions. If we look at, for instance, foreign-derived intangible income as a result of U.S. tax reform, the question is, aren't these important upcoming potential trade tax disputes, and how do we deal with this as advisors and as taxpayers to mitigate risks, but also to tap from opportunities that this might generate? So with this, I would like to hand over to Jeff for some perspectives, particularly perspectives in the context of China-US. Jeff, over to you.
Thanks, Isabel. As we all know, much of these trade disputes between China and the U.S. are already creating the volatilities in companies' financial performance. Hopefully, with focus of the two administrations' efforts coming to agreement, starting with the negotiation in Beijing, we'll see some real positive impact on both sides of the ocean and also the entire global economy. But some of the key disputes reside with the current system China is running. So such a push is surely aiming to have some of the structural changes in China from business point of view. Before we're seeing positive impact for such changes or improvement for the business environment for the multinationals, we're going to see the slowdown, and we are seeing the slowdown of economy and also gloomier mood and market sentiment created by such trade disputes. But as China is already feeling the pain, it prompts the government to come up with a series of pro-business policy and regulation already. Just from the tax aspect, such efforts already range from more attractive individual income tax regulation to introducing more generous R&D credits for the companies spending on the R&D activities. Also, we will be expecting to see more measurements from the government to promote more domestic consumption, inbound investments, as well as more trade alliances with more countries and regions. So hopefully that will bring more positive impact to the global economy. I'd like to pass to Pascal and just let us know what you're seeing the situation from the other parts of the world.
Thanks, Jeff. Well, an experience that I would like to share is basically not as such linked to a trade war, but there is a big trade component in there, and that's Brexit. What you've clearly saw in the last 2 years, because Brexit will happen end of March this year, is that quite some companies took a rather defensive and hesitant situation, in a sense like, okay, this is going to happen, but it will probably not be that harsh as everybody's expecting. And whereas if companies then move into action where you see that the predominant focus is in first instance on the indirect tax component, so what are the tariff disruptions that such a trade war might bring, you immediately see that it goes way beyond. It's not only about tariffs, but it's also about lead times. It's about getting your products at the right time at destination. Think about pharmaceuticals, think about food and stuff of the like. And one of the immediate consequences that we tend to see now is that companies start reassessing basically their value chain, their supply chain. Is this still the right way to operate in a changed economic environment? And that, I think, is where it comes way broader than only indirect tax, and that you have also things like transfer pricing kicking in. If you see that companies are shifting manufacturing from UK to mainland Europe and the other way around, start building up stocks, transferring IP, start charging royalties, then I think you're immediately in the intercompany transaction sphere. And that, I think, is where the main item lies, that it shouldn't be seen from one single-sided aspect, but it goes very broad and has a significant tax impact.
Thanks, Pascal. This is interesting. As a transfer pricing practitioner, I'm not that acquainted with things like impact on tariffs, on lead times, because you're touching on the business impact of all this, how to get my products to market swiftly. I heard Jeff talking about R&D credits, about stimulation of domestic consumption. These are all concepts that are pretty novel or a bit uncommon for transfer pricing practitioners to deal with. And I think this is a good moment to hand over to Will. Will, our trade attorney based in Hong Kong, part of our trade attorney network on that topic. Will, maybe a few sound bites from your perspective would fit in nicely now.
Sure, thanks very much. So in this part of the world, we're seeing quite a lot of developments, particularly around the U.S.-China trade dispute. And this is accelerating trends that have been in place in China for many years now, which is the search for lower cost production, particularly at the lower value add sectors. And so many of our clients are looking to either find alternative intermediate input sources or relocate their manufacturing entirely to Southeast Asia and other jurisdictions outside of China. So not only does this bring them potentially outside of the scope of the U.S.-China trade dispute and the additional tariffs that come with that. But it triggers a number of corporate structural issues that are raised. So taking a look at all of the related party transactions that are necessary to effectuate that migration, and to really look at the potential migration of intellectual property and related things. In addition to that, our clients are looking for advice on possible customs valuation structures that may reduce the burden of the additional tariff measures in the U.S.-China trade dispute. So even if they're not in a position to relocate their manufacturing because maybe they have a particularly complex or high value add or heavily invested manufacturing operation in China, they still want to seek alternatives to reduce those burdens. And so one of the obvious opportunities, depending on where the commercial markets are for our clients, is to look at first sale for export valuation into the U.S., for example, which may reduce the customs declared value and therefore the additional tariffs that are owed under the U.S.-China trade dispute. And then, further to that is really taking a sharp pencil to all of the intercompany transactions that are in place now for our clients. So, I think it's well to remember that many of these products that are subject to this trade dispute have never really had duties subject to them before or applied to them before. And this is also true in the Brexit context. So to the extent that there are products being manufactured in the UK that may be sold around the world under the benefit of an EU trade agreement, query whether or not those benefits will carry forward, after Brexit is finalized. And so a lot of our clients are really trying to take a look at more carefully what needs to be dutiable, what doesn't need to be dutiable with respect to their intercompany transactions. How are we defining intellectual property rights that are being granted under licenses? How do we determine the quantum of those royalties associated with these intellectual property licenses? And really looking at the transfer pricing agreements with a fine-tooth comb to determine what do we really need to pay, duties and related indirect taxes on, and what, maybe is properly outside of that scope. And again, most of our clients in these areas have never really had to deal with the burden or the discipline of these kinds of tariff measures before. So I think that it's causing a lot of, sort of broader operational and financial concerns for our clients.
Thanks, Will. I would like to get back to Jeff on a few points because this is quite interesting as development in how we should address the global value chain, to put it that way. We are just digesting, or we just try to digest the OECD BEPS agenda, which was very much about how to increase the pie rather than redistribute the tax pie over various countries. Now we feel that there is a tremendous opportunity to start from the business impact to look at how companies are unwinding, reassembling their supply chains, what the direct aspects of that are, what the indirect tax aspects are, not only from a trade tariff perspective, but also from a VAT perspective, so to say. But if we look at this sort of value chain transformation opportunities that we have now, I'm sure, Jeff, for your region, there are some particular matters of attention to look at, right?
Absolutely, Isabel. I think it's a kind of a rude awakening for the transfer pricing officials we normally deal with in our region, and understanding more profoundly about the company's measurement and movement is not purely based on tax, or not purely based on income tax or profitability shifting as they would have expected all along. Certainly, there's so much more involved the business has to consider to make a decision with. But just particularly for such a value chain changes we're talking about, and first of all, such a dispute is already creating a decrease of profit. So for the companies running under a limited risk profile, how do they stabilize their profit? Even for the company with a full-fledged nature, when with the license arrangement, how do they deal with the royalty payments? Now the bottom line profit drops. That's obviously going to have more pressure for the companies paying the royalty out. Now switch back to those supply chain changes, and obviously we see a lot is the company are considering moving out of China, so that created opportunities for the neighboring developing countries such as Vietnam, Thailand, for the manufacturing activities inbound. But just with that, and those companies ought to consider how to deal with the financial subsidies and incentives granted by the local government before, and how to unwind these operations from China to the outside of China. But these are not just a negative impact, and we also should look at some of the opportunities. For example, company ought to look at it, how to take advantage of those latest incentives that I was mentioning, about potentially the relaxation of some of the regulations government trying to create. And certainly with the current transfer pricing audit environment, we also see the opportunities for the company to close some of the historical dispute issues with the government, as well as the government trying to promote more business-friendly environment. And the last, I also see the APAs are concluded more, and then see more proactive attitudes from the competent authorities, at least from this part of the world. So with that, Will, are you seeing any further challenges, opportunities other than what you just mentioned from your custom and trade area?
Yeah, I think, Jeff, adding on to some of the issues that you identified already, is we are definitely seeing clients in a position where they're already having to adjust transfer price as a result of performance that has not met their projections, and that has really caused not only obviously the transfer pricing adjustment concerns, but it's caused a lot of the customs valuation concerns related to those adjustments. So the trade dispute is, not only is it adding additional cost burdens of the tariffs, but it's also a bit of a downward pressure on the sales and profitability projections. And so that's having a knock-on effect both for transfer pricing, tax, and in the customs and trade space. So there are definitely a number of clients who are in a position to have to face this problem already. We expect that to grow as time goes on through the year.
Okay, super, Will. That's very important. Maybe before going to some concluding thoughts, Pascal, what's your key takeaway of all this?
Well, when looking at it and being actively involved with a number of clients, my definite takeaway would be anticipate. Rather sooner than later, do an impact assessment and do that assessment as broad as possible. I am an indirect tax guy, but I would definitely recommend to take that broader than indirect tax only, because it basically kicks into the operational aspects of the company itself. And therefore, I think a well-thought structuring or a reconsideration of the value chain and supply chain is a key takeaway for me.
Yeah, and I think it comes at a good time as well. This is not something that we thought might be of interest only now. I grabbed the occasion to refer to comments made about a month ago at Georgetown University Law Center, where Professor Hillman, specializing in trade law, was saying, if you look at the World Trade Organization, there are some 500 WTO disputes pending. Only 40 of them are tax-related, but we expect a surge in them. And this is the reason why I said in the introduction that things like European digital service tax, U.S. foreign-derived intellectual income might give rise to WTO disputes. Also, what Jeff was mentioning on R&D credits, it's not only in China, but also in the rest of the world. The EU has put forward rules on the nexus approach, making sure that you would have a state aid compliant sort of royalty box. Well, that doesn't necessarily mean that you're home free from a trade law perspective. So all these elements are making that it's a good time to look at your value chain as a whole, particularly towards relocation of things like production capacity. What does it mean from a transfer pricing strategy, but also from an indirect tax perspective? What about exit tax? When I do that, is there a sufficiently identifiable asset that I have been transferring across border? What about my custom strategies? What if I had, for instance, a region-wide agreement on an exemption? Does my relocation of production capacity mean that some products become dutable? So will some products become at risk? What about high-tax products? Is it a product? Is it a service? We should not forget that there are no rules on e-commerce in the World Trade Organization yet. There is only a work plan. So in the meantime, there is a sort of a moratorium, but countries are thinking of, for instance, customs duties on e-commerce, Indonesia, just to mention one. So this is something that will become more and more important. So we have to look at these elements. We have to look at IP strategies, intellectual property. What about licensing arrangements? What about royalty structures? Are my royalties dutable if I make changes to that? And at the end of the day, and I would like to conclude with that, it's a good time to look at your master file. It's more than just a compliance thing, because the master file, in essence, contains your thoughts about how the system profit is ultimately divided over the various entities in your group. So it's a good time to look at it from a multi-angle perspective. And with that, I would like to thank you for having listened to our podcast, and I hand over to Dana for some concluding thoughts. So back to you, Dana.
Thank you, Isabel, Jeff, Will, and Pascal. And of course, thank you to everyone who listened to this podcast. If you would like further information about this topic, please contact the speakers. You can find their contact information in the description of this episode. Thank you.